can see the title of the slide pack I have here is called Climbing Out of the COVID Slump. I mean, that really is what we are doing at the moment. We've seen an extraordinary drop in activity, not just in Australia, but around the world. Until we do get a vaccine and that adoption of the vaccine is widespread, then this health crisis will continue to dominate the economic outlook, and it will continue to pose downside risk to Australia's outlook. When we're forecasting, we're sort of assuming that we keep the virus under control. It wouldn't be sensible to assume another wave of the virus. So that will always pose a downside risk to our numbers. And so that's something to be cognizant of. So the chances that we get sort of a widespread vaccination program by the middle of next year have now increased substantially. And that will make a very significant difference to the outlook. So 2020 is really going to be a very difficult year, a 3.6% contraction in GDP for the year before a big bounce in 2021 and very solid growth again in 2022. GDP in the US fell just over 9% in the June quarter, and then it rose around 7.5% in the September quarter. So what looks like a very V-shaped recovery there. We have to keep in mind, though, activity is still around 3.5% lower in the US than what it was prior to the pandemic. And those further gains will be much harder won over the coming sort of year or so, I think. We're seeing generally upside surprises to economic data. When you look at sort of what we call an economic surprise index for the globe, so whether data like labour force data or industrial production data or retail sales numbers are coming out ahead of expectations, and that is generally the case. What we're seeing around the world is this beating of expectations around the data. So that is a very encouraging sign. And this time around, even though we're seeing case numbers rise, we're not seeing the same sort of economic effect. And that's because to some degree, businesses have adapted, households have adapted. I would also keep in mind that, Australia sells around 75% of its goods and services to the Asian region, and Asia generally has performed much better than some of the Western economies. So it puts Australia in, I think, a good position to leverage from the recovery in Asia that's coming through at the moment. In the second quarter, GDP fell by 7% in Australia, but on this chart, we were the best performer, really. Even when you compare us, when these numbers came out, New Zealand wasn't out, but we beat New Zealand. You can see much better than the US, much better than the UK, where GDP declined more than 20%. So we really have performed quite well here in Australia, both in terms of the economics, but also in terms of flattening that virus curve. And I would keep in mind too that part of the reason that markets and economies have performed relatively well is the size of the stimulus that we've seen. So in Australia, it's been incredibly large, but that has been the case around the world. If the IMF estimates that fiscal stimulus in this crisis is more than 3 times what was delivered in the wake of the global financial crisis. So that is very significant, and that is really helping to support the recovery. And I think eventually what we'll see is that will drive, quite a strong recovery if that stimulus is sustained for long enough. What does a Biden presidential victory mean for Australia? The main priority for the Biden government at the moment is this fiscal stimulus. They've had a lot of problems getting the stimulus through Congress in the US, with Republicans refusing to pass a very large stimulus bill that the Democrats had. That stimulus of around $1 trillion seems like a realistic sort of number for Congress to pass. So that will be, I think, really good news for Australia, and the world relies on the US to a large degree. And so strong growth in the US will be good for Australia's economy. So the current state of play in Australia. With the budget, what the government did was really transitioned away from that income support more towards stimulus and incentives for the private sector to step up and spend and invest, like the instant asset write-off and the loss carryback. And we had expected that the government would spend a fair bit more on infrastructure and those sort of nation-building projects, and that hasn't been the case. So they're really attempting to engineer a much stronger private sector recovery. Now, there's certainly risks around that. It's a less expensive option for the government. But at the moment, I think that the way that things are recovering is that it suggests that they made the right decision there. Now, the second quarter should look considerably better. I expect that we will see a pretty solid gain in GDP, even though Melbourne and Victoria was locked down for most of the September quarter. The rest of the national economy looks to have grown enough to offset that. And in the December quarter, we'll have the impact of the reopening, which will be quite significant. So it is a pretty tricky outlook, but I think it is looking quite positive at the moment. So we will see business failures here. You know, the insolvency protections have really helped to limit that for the time being, but there will be many businesses, whether they're based in Melbourne or in Sydney or elsewhere, that won't have been able to see this through. So you can see there how vulnerable many of these businesses were. That dark blue line where it says COVID-19, they're our current forecast. The dots are our current forecast for the unemployment rate. Given how well the economy's improved, there are probably downside risks to that unemployment rate. But this is going to continue to be a priority for policymakers, because high unemployment will be a drag on the economy and the recovery for a long time if we are not able to push that down quickly. So looking ahead, at the moment, we're not really expecting GDP to recover to pre-pandemic levels until 2022, and the same goes for employment. So that's a long time for the economy to be running below capacity. Now, some of the more recent data suggests actually that there are upside risks to that. In the latest survey from the ABS, non-mining firms said that they were planning to decrease investment in the current financial year by 20%. So very disappointing result for non-mining business investment that already wasn't very strong. Now, I think that the government policy on incentivizing investment is likely to turn that around. I think when we get some new results on this in late November, then we will see a much better outlook there. So some of the places that we can look for signs of that are things like business confidence. Things like within the business surveys, like the NAB survey, they ask particular questions on CapEx spend expectations. We can watch out for business lending, those sorts of things. And if and when we start to see those pick up, then we can be a bit more encouraged about the investment outlook. It might take a few months, but I think we're likely to see some improvement there that will flow through next year. The housing market has been much more resilient than we expected. Prices have fallen just over 2% when most commentators expected a decline of about 10%. Auction clearance rates are a fabulous guide to house prices, and we get those results every week. So these data suggest that house prices, could pick up to as much as 15% annual growth. Many people own their own homes still. This helps them feel wealthier, and it helps encourage them to spend. It's also flowing through to housing construction, and that's a very big employer, a very important part of our economy. And so that is a good sign, I think, for the economic outlook. So you can see there the very fast recovery in Victorian spending as the doors opened up on businesses and homes. And I expect that we'll see that current strong growth in Victoria continue. Again, when we look at things like restaurant activity data, that has picked up very strongly in Victoria, a really encouraging sign that people are willing to get out there and about, people are willing to spend, and hopefully higher as well. So really, again, another upside risk to the outlook. Conditions and confidence have picked back up. They're a little bit below long run average, but they're actually, importantly, they're above that zero level. So that means on balance, there are more optimists than pessimists. Consumer confidence has recovered partially. Confidence is the best stimulus that you can have, and it really is a very big determinant of the outcomes that we'll see in the economy. And if we continue to see these improvements, I think that in and of itself suggests people will be happy to invest, happy to spend, happy to hire. The jobs market is looking a lot better. So this is ANZ job ads. We've had a really strong recovery over the past few months, and we've recovered about 3/4 of the initial plunge in job ads. So that is a really encouraging sign for the labour market, and again suggests that the unemployment rate will fall faster than what we currently expect.
Thank you to Felicity for the presentation. That was excellent. Thank you very much. Some great insights there, and I'm sure everybody enjoyed that. Thank you.
Thanks very much.
So for those of you who don't know too much about Moir Group, we are a specialist finance and accounting recruitment business. And we look after roles from junior assistant accountant through to CFO level on an interim and a permanent basis. And we see events like this, as well as some of our smaller events, as learning opportunities and an opportunity to stimulate thought and debate. At Moir Group, our interim and not-for-profit business have been very strong parts of our business over that eight months, being very busy. And our permanent and executive businesses are certainly showing signs of improvement.